couple months ago, I said silver had a ways to go to catch up to gold. Well, it did, and then some. We're going to talk a little bit about that and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. The monitor behind me logged off, but I figured I'd wear my Open Mic hat given to me by producer Jay, so everybody knew where they were today. If you didn't, from the logo that's sitting on the screen already. So this is a topic that Mark Guthner and I have brought up a couple of times. I think earlier, I should say, last year in 2025 and possibly in 2024, that gold obviously has been on a multi-year bull market. Copper, some of the industrial metals like aluminum, and also silver were lagging for a while. Silver in particular is something that's tracked because silver, unlike the industrial metals, I suppose we could say copper, I mean it's used in pennies, but silver was actually pegged for a time. So it was pegged to the dollar in effect, if you will, up until the early 1960s. At that time, in fact, actually what I'm going to do here is I'm going to actually show a long-term silver chart so we can actually see exactly that. And I think I can do a logarithmic that goes way back. So let's do this. So you can see right in here this situation where silver is basically dead straight. And that is because it was pegged. They got rid of the peg, and I want to say I think that was 1961. I can double check that. Maybe somebody else can double check that we got rid of the peg in 1961. And at that time, silver effectively doubled. Now, we were, of course, still officially on the gold standard, or what version of it came after the Bretton Woods Agreement, until the 1970s. And then Nixon took us off the gold standard, went through a period of rapid inflation, and silver took off again. So we had this huge run-up right in here. That was pretty sloppy how I did that marking. The most famous move of all in silver probably took place in the late 70s and into January of 1980. And that was when William and Nelson Hunt, also known as the Hunt brothers, who were very concerned actually about a lot of the same things that people are concerned about today, which was monetary debasement. They were very concerned about inflation and that the dollar was going to get crushed. They started becoming huge acquirers of silver. And they were buying physical silver because I think arguably they knew or had remembered that the United States had actually confiscated people's gold. So they were buying silver bullion and shipping it to Switzerland and having it stored over there. And of course, they were involved in the futures market and a whole bunch of other stuff. In any case, the Silver Thursday, is that what it was called? There was, when the market finally rolled over, it rolled over principally because, number one, they were highly leveraged. And there was a combination of two things. They increased the margin requirements, and they imposed other rules. In effect, they moved the goalposts. And when they moved the goalposts, the Hunts ended up having an enormous margin call, and the two brothers actually ended up, who were cornering the market, they ended up filing for bankruptcy. There was a bailout that was involved. They lost over $1 billion. Fortunately, it didn't take their entire family fortune with it, so they had some other siblings and relatives that were not involved, and they managed to preserve a portion of the family fortune. Hunts are still amongst the wealthiest families in America, even today, despite having lost $1 billion in their ill-fated efforts to corner the silver market. Now, the reason I wanted to bring this chart up was because this move, when they were cornering the market, was an immense, in percentage terms, increase in silver prices. Almost 1,200% from peak to trough. I'm going to call the trough this mid-1970s level up to January of 1980. Every other one of these bull markets was probably closer to, let's say, we'll actually measure it out. Why not? So that one right there, 430%. And we can take a look over here. That was 122%. It fell off. And basically what I'm doing is I'm just taking a look at the bull markets as to be measured before there was a subsequent bear market. And we can see clearly here that if you said this was a longer trend, you might argue that the real trough to peak was over here. But that's not the case because silver fell 60% off of that nearly 430% gain. And then we had another one in here, another 488%, whatever. The reason I bring all of this up, and so we had this more recent big rally, but there was a formal bear market that followed it. So that was 160%. But if we take a look at the period immediately following that, that was a decline of 41.6%. So that 100%, we can say that was a bear market in silver that followed that big run up. And now we have this one, which is now the second largest in history after the Hunt brothers. Now, let's start by saying the following, which is that, and I've said it many times, this is not new to any of you, that the underpinning concerns that have led folks into this trade, whether it is silver, whether it is gold, whether it is copper, whether it is Bitcoin, whether it is stocks, frankly, that remains true. We have serious fiscal problems. We have tried to cure every economic setback with aggressive monetary policy. And that means that people are concerned, rightly, about debasement. Fiat currency is based on the faith that the people who use it have in it. And if you start to lose that faith, then you're going to start looking for hard assets of almost any other variety. But whatever the reason and whatever the rationale, that does not necessarily mean that any price is still okay. And as we look at this, with silver up more than 500% in this most recent bull market, a reasonable investor would say, is this going to continue such that we have a bull market in silver that approaches or breaches the Hunt brothers circumstance? So if it was going to be as large as the Hunt brothers rally was, that would effectively mean that silver would go up 100% from here, that it would double again, that it would trade over $200 an ounce. But the only time in the last 60 years that we had a market that big was when there was deliberate and aggressive market manipulation from people who are actually cornering the market. And they effectively had. They were taking up all of the physical and shipping it overseas. A combination of market surveillance, margin requirements, and the fact that if the market gets too overly manipulated, we know that they do come in and change the goalposts. It seems unlikely to me that we are going to see a recurrence where you get an event that big. The blow off top by my guesstimate, is probably going to happen well before we get to that level, because it is harder mechanically for the market to actually make that kind of a move. All right, so let's give it some other context. We can look at the gold-silver cross, which I think is kind of an interesting chart. What are we looking at here? What this is a measure of gold divided by silver. And what's it tell? Effectively, how many ounces of silver buys 1 ounce of gold. And is this as low as that has ever been? No, not as low as it has ever been. But we're definitely getting down towards the lower end of the range. So, you know, there were periods when the number was a little bit lower, as you can see here. But for most of the time, it has been considerably higher. So, generally speaking, going back for a half a century or so, when you could trade 50 ounces of silver for an ounce of gold, it was probably a good idea to do so. Because another way to think about it is that under the worst of circumstances, let's see if we can throw some moving averages in here. That might, I'll just change these up so we, this is longer term, because this is, you know, we're looking at quarterly. So if I was going to look at, say, maybe I'll put 5 in here as a smoothing mechanism. Or actually, let's make it 12. Let's see what that looks like. Okay. So this is basically the 3-year moving average of the relationship between gold and silver. And the reason I wanted to have a moving average is to say that there was a period in here, a decade perhaps, where, you know, trading 48 ounces of silver for an ounce of gold wouldn't have been that great. Had you done that, this is about 31.5, which means that at the worst of times, you'd have lost about a third of your money in the trade. That was the downside. But for most of the time, you'd have been better off. So here's another way to think about it. In 60 years, 10 out of that 60, you'd have been a loser, trading 48 ounces of silver for an ounce of gold. And during that time, you'd have been down about 30%. But for the rest of time, that's 50 years, you'd have been better off making that swap. What is the thing that you should be looking for, in my view? You know, the biggest catastrophe in commodity pricing since I've been doing it is, you know, that ugly downside reversal. What's that? The ugly downside reversal, you know, that most brutal of patterns, is going to take place when you keep gapping open to fresh new all-time, oops, sorry, that's the cross, I didn't want that. To fresh new all-time highs. What are we waiting for? And look at this. I mean, boy, look at what this thing actually did today. I mean, look how much lower this is than its intraday high. I thought today might be the day. I actually wrote an article about this, that I had a feeling we were going to gap to a new all-time high and then ultimately end up closing lower on the day, and maybe even sharply lower. That is not a good technical setup. So what do you do? Because a lot of people could have said at many instances along the way, well, aren't you supposed to let your winners run? Yep, you are supposed to do that. That is true. And aren't there many instances in this run right here where you could have said, this thing is overbought, take profits? Yep, there are many times when you could have done that. I'm going to offer an alternative, which is for anybody who's watching right now who's long silver. I wish I had pulled it up, that hi-ho silver away from Bruce Almighty. Jim Carrey, you know, he's getting in, he gets into his crashed Z, and he makes a wish basically, and he's in a Selene instead. But I wanted to show you guys this sort of setup. And I'm actually, before I get to that, I'm just going to show you one quick thing here, an important dynamic that's going on in options prices. This is not unique to silver. It's not unique to gold. It's a fairly common situation. I have talked about this before with commodities, which is that equities in general exhibit negative skew. That is to say that downside puts trade at a premium in vol space to upside calls. We can see that here. We don't need to see a bunch of them. This is 3 months. So we can see that a 10% out of the money call, a put, excuse me. And actually, you know what? Let's do this. How about that? We're going to say that a 10% out of the money put, which I'll delineate in red, trades at a significant premium to a 10% out of the money call. And what this means is that if I put on a risk reversal, if I sold this downside put and bought that upside call, I'm going to collect money. Right? So that's one way to think about it. Or alternatively, I could say I could sell a downside put and buy a closer to at the money upside call instead. Well, in commodities, it is not uncommon to see the opposite. Because oftentimes in commodities, the stress in the market comes when there's a short-term supply and demand imbalance, where the upside calls actually trade at a premium to the downside puts. And that's what we see here. 10% out of the money call is significantly higher in vol space than the 10% out of the money put is. So what this actually means is that if you own SLV, or if you own silver futures, you can buy protection that kicks in much sooner than the upside participation you have to sell to get it. And I am going to illustrate that right now by creating a trade on it, if I can. Right there. So we're going to assume you're long the stock, shown here. And we're going to further assume that you say, okay, well, I disagree, Mike. I'm not gonna take profits right now. I think this. I'm not worried about this downside reversal. Okay, fine. I mean, that's everybody gets to play the game the way they choose. But let me just offer the following idea. This is trading close to 100. I'll just make this the 90 puts. You could at least throw a collar on. And I'll admit that I was wrong if... So this thing right here, I can go maybe around there. Actually, this skew isn't quite as pronounced as I thought it was actually at the end of the day. But here, these things cost roughly the same amount, right? So they're within 50 cents or so of each other, 60 cents. You can see that here, all right? So I can sell a $20 out of the money call that expires in March for almost the same price as it cost me to buy a $10 out of the money put with this close to 100, okay? So that gives you twice as much upside as downside risk. What's another way to think about this? Well, if you were going to make a bullish bet, you could try to buy an upside call, or you could buy an in-the-money call with less decay, or you could trade an in-the-money call spread. So if I bought the 90 strike call options, and I say sold the 120s, right? So these things right here are $8 and change in the money. What that means is that you basically have this call spread on, a $30 call spread. You're going to spend $8.65 for it. Okay? That's basically how much it is in the money right now. Max value, $30. So you could make $21.35. That's your max gain. Your max loss is the $8.65 that you spent to get it. And if silver ends right here as of the end of March, no harm, no foul. It's a push. I don't think it's going to be right here at the end of March. Could it be higher? I mean, I've said many times, I've never top ticked a thing. I'm not going to top tick this probably. But boy, I think we've got to be getting close. I just find it very hard to imagine, frankly, that we have a recurrence of the Hunt brothers run-up in silver. And if we do, that could also indeed be indicative that we've got bigger problems. But that's what it would take, okay? In order for silver to double from where it is right now. And this trade still offers 20% upside, folks, okay? But for silver to double from here means that this bull market in silver would be of the same magnitude as the Hunt brothers cornering the silver market. I'll let you guys decide for yourselves whether you think that's realistic or not. My own take on that is that it's not particularly likely. That's not my thinking here. Possible, not likely. So, with that, let's get on and take some of your questions. And I should have had my live stream comments up here, but it'll take that. And actually, there was I got some questions in the YouTube channel. So I often ask you guys to leave questions and comments for me there. You did. And I am going to quickly try to find one of them. Oops, no, that's this one. Because I think I got two questions that I wanted to answer. Because otherwise, what's the point of you guys putting questions in there if I don't answer them when you do that? So back here on the 21st, let's see here. So FinWest, you said, thanks for fielding the question on the stock scan process. Took a screenshot, uploaded it into ChatGPT, asked to extract the company names in the left column and export CSV. Worked great. Only one small error. It interpreted the lamb of Lamb Research as L3. You think AI has a future? Indeed it does. Yeah, I'm sure. Ranjana Gupta. Hi, Mike. Love your webinars. Why don't exchanges list weekly options for all stocks with options? Also, why don't they have strikes in increments of $1 in all options chains? I'm sure all investors would want this. More choice, always better. Does it cost anything extra for exchanges to offer this? Thanks. Yes. Yes, it does. So, in fact, there was a point when I was still on the floors, on the trading floors, that the constraint was that we couldn't even push the quotes on the existing contracts. So what is the cost of increasing the number of strikes, the number of expirations, tightening spreads? There's an expense that's related to all of these things. And it has to do with generating quotes. So let's just talk about it from the market maker's perspective to start with. Every single time the underlying asset changes price, the theoretical value of all of the respective options that are listed on that underlying asset similarly change. Every single time implied volatility moves up or down, the theoretical value for all of those individual options changes. As time passes, instantaneously the change is infinitesimal, doesn't make a difference. But as time passes, the value for every option that's listed changes. And the market makers have what are called quote engines. What the quote engines do is, based on the input of the price, the amount of time, the implied volatility, and all of those things, it's calculating the theoretical value for every option continuously. And then the quote engine will actually generate quotes and spit that out. That's what you see on your screen every single time you log on. So, for example, I will just pull up the SPY options chain right now, and you're going to see what we call the options chain. The options chain is all of the strikes, all of the expirations, all the bids and offers. I could actually have volume up here. Now, the volume is a number that is being generated by all of the individual market makers and then aggregated at the exchange level. So if I actually put that in here, which I didn't bother, but we could add a volume or actually a size. It's not really a volume. Volume, when we talk about volume, we're talking about things that have actually traded. When we're talking about size, we're saying how big is the quote? How big is the bid? How big is the offer? So all of this stuff is updating continuously. And that generates, number one, is computationally quite intensive to do that work. And the more strikes there are, the more calculations you have to do. The smaller the pricing increment for the underlying instrument, the more frequently you have to push a new quote because the more of a difference that it's going to make. Put differently, if I have an option, and we'll just pick one, just so that I think sometimes it's more intuitive here for speaking in actual examples. So let's just take a look at an option here. And I'm looking at the March 31st month ending 690 strike calls. So slightly in the money call. This option's worth, we'll call it $19.90, right? Well, if the quote increment was 10% of the value of the option, that would mean that the quote would be $1.90 wide. So I have a $19.80 option, and maybe I'm 18.5 bid at $20, something like that. So I'm $1.50 wide on my quote. Well, if the theoretical value of the option changes by 1 cent, 2 cents, 5 cents, I don't really have to change my quote, right? I could just leave that quote up and it's still good. I'll still be buying below my theoretical. I'll still be offering above my theoretical. If, on the other hand, the pricing increment is down to pennies, and we'll look at like the next contract down here, the next expiration down to April, because sometimes the month ending aren't trading quite as tight. We can find some options like these 694s. These things are only 4 cents wide. A relatively small change in the theoretical value of the option, and the market makers have to update their quotes. Now, if you increase the number of strikes, and you increase the number of expirations, and you increase the number of market participants, that quote traffic becomes enormous. I can remember when the quote traffic for the entire U.S. options market was measured in less than 100,000 quotes per second in the late 90s. So in 1 second, if things started to update, there might be 100,000 quotes in that second. Well, there are so many options out there now, and that was at a time when things traded in eighths. Then they traded in teenies, which was half of an eighth. So now we're looking at 6 1/4 cents. Now they trade in pennies. It increases the quote traffic. So you have to do calculations. You have to calculate the theoretical value for more instruments more quickly, push more quotes. So that's part of the problem, but it's not the only problem. The other issue is that once upon a time, the markets were what we call single listed, which means there were 4 options exchanges. There was the Amex, the American Stock Exchange in New York, 86 Trinity. There was the CBOE, also known as the Chicago Board Options Exchange. There was the Philadelphia Stock Exchange, and there was the Pacific Stock Exchange. Those were the 4 places where listed options traded. And in many instances, single underlying instruments were only traded in one place. So, for example, Dell options only traded on the Amex. Dell options only traded on the Philex. Intel only traded on the Amex. Philip Morris only traded on the Amex. Ford, I believe, only traded on the CBOE. Apple options may have only traded on the Picos, and so on. And what that meant was that they not only did you have fewer market participants and wider spreads and fewer strikes, but on top of that, market makers didn't really have to push quotes in response to what was being quoted by some other market because their market was the price. So the specialist or the lead market maker would push the quote and other market participants would say, I'm good on those prices. Fast forward to the present, and now we have myriad exchanges. And if one market maker changes their quote on one exchange, market makers on another exchange might say, well, I'm willing to participate on those prices, but my prices are not the same as theirs. So I now have to update my quote, not just based on what my quote engine says, but what on their quote engine says, and now I'm going to match that. So they're doing two things, calculating the value and watching what everybody else is doing and changing their quotes in response to that as well. The quote traffic now is millions of quotes per second. It is orders of magnitude greater. And whenever you start increasing it, the number of expirations, the number of strikes, all of this, it increases the computational lift quite considerably. It also just the quote traffic lift quite considerably. And the way we dealt with it at the time is that when the markets went to fast market conditions and the machines couldn't keep up with the quotes, is that some of them would just go stale. We were just allowed options that didn't trade very frequently not to update. And we were not held. Not held means that even though a quote exists, if an order came in, it wouldn't auto-execute, and they'd actually have to go down and check with the traders and see what it actually meant. So I hope that helps. It does make a difference. We're about to get Mondays and Wednesdays. So the capability is there. It's always growing. It seems like we're on a one-way trip to more strikes, more expirations, more optionable securities, more quickly. And we haven't even got, well, and then the producer just mentioned what I was about to say, which is what a lot of other people are asking for, which is extended hours trading or trading 24/7, right? So thanks to Moore's Law, we actually are able to do these things because the capability of the relevant machines is, also increasing in their capabilities too. So, but there is an issue with it. And to that point, Touch of Gray says, love the show. Could you please opine on the potential impact of the addition of 0 DTE Monday and Wednesday expirations for the mags? So, yeah, this plays into this. I think one thing, and many of you who have been watching the live stream for some time will know this already, but it probably bears repeating for those who either haven't seen it or don't remember. And that is that just in general, when we think about options, the pace of an option's decay, the rate at which it decays, the theta, that's the Greek letter that is used to describe the decay of an option. It accelerates as a percentage of its own value as expiration approaches. And of course, it becomes 100% on the day of, right? So an option that is listed in the morning and expires at the end of the day must by definition lose 100% of its extrinsic value. So the decay is 100%. So this dynamic has meant that many people are interested in selling really short-dated options because when you annualize those numbers, they get really large. We already have 0 DTEs, and let me illustrate what I'm talking about. So SPY options, we can look to the options that expire tomorrow, and we can see that it's 692.73. 693 calls $1.25-ish, right? So as a percentage of the underlying share price, that's not that great. That's 18 basis points, right? But if you multiply 18 basis points times 252 trading days, that works out to 45.5% per year, annualized. And that's just simple multiplication. That's not like the compounded rate of return. So there's been a lot of demand for short-dated options by people who sell options because they have stars in their eyes, I would suppose, based on the notion that they might be able to annualize these accelerated decay estimates and make huge returns. They are also appealing for people who use options on the long side, because for folks who used to day trade with leverage, it's a lot easier to just say, take a quick punter on a short dated option, and by the end of the day, you won, you lost, and it's fairly straightforward. So, a couple of things about this. For those that would sell, I would say, watch out, because while it is true that if one compounds, if you look at the geometric compounded annualized rate of return of selling short-dated options, that looks really appealing. But in fact, on any given day, whether you win or lose is going to be dictated essentially by the price movement of the underlying asset. You're not going to collect anywhere near that rate of return annualized. And especially if you start doing this on single stocks, because single stocks have idiosyncratic events. You do something like that going into earnings, and it is not something you can't annualize that number. You get 4 earnings days per year. If you're going to make that play, you're going to have only 4 discrete events. You don't get to compound the rates of return over 252 trading days, because earnings don't happen 252 trading days in a year. And it's going to be a coin toss for many, whether you get that right or wrong. And if you're selling options, the amount you can make as a percentage of the stock price on that one discrete day is relatively small, but the amount you could lose is quite substantial. And this is where people who are only selling options and only trying to do the shortest possible day because they are sort of making that geometric compounded rate of return assumption are getting it wrong. On the other hand, for those who are just trying to punt it around and make directional bets, consider that it is hard enough to get the direction right. But if you're trying to do so by using really short-dated options, you have a considerable amount of trading friction that's getting in your way. So you better be pretty good at making your predictions, because if you're not, that cumulative slippage, that's what we call that. So the combination of lifting offers, hitting bids, just the general transaction cost, the friction, and that decay, the cumulative effects of that can be quite challenging. So it's one of the reasons why I would generally argue in favor of, I think it's great that traders have more stuff available to them. I think for those that are doing more sophisticated strategies, if you are, say, for example, if you're trading dispersion, what's dispersion? That's when I'm buying a bunch of options on single stocks, selling it on index because I think there's a volatility disparity there, and I'm trying to take advantage of that. And then to add a little bit more nuance, I generally own it into some of these catalysts, but I'm also a bit concerned about what happens around them. These short-dated options can help out. But I will say that, sometimes, you can have an embarrassment of riches in terms of strikes and expirations, and it can give people things like analysis paralysis problems. Are you able to trade if you're really trying to decide, should I trade the zeros or the ones that expire next week? I think it's probably, for most investors, better to say, here are stocks that I like. These are technical setups that I like. These are levels that I think are reasonable over time, and to do it like that. But yeah, I mean, it's not my problem. I'm not the one paying for all these servers. So if they want to list more stuff and everybody else wants to have more of them, go forth and prosper and all that. But I would just issue those cautions. All right. Okay. Jim Howard. Mike, this morning a CNBC guest mentioned that he believed a lot of money from Bitcoin was moving into the silver and gold trade over the last number of weeks. Your thoughts on this? I saw something interesting, and one of the comments I saw somebody make was that a lot of the money in silver was flowing in from ETFs. And I thought, oh, well, that's interesting. What is one of the ETFs? Well, that could be something like silver, right? And I was curious. I thought, okay, well, is a lot of money flowing into it? Or is there more money in it because silver has appreciated? How do we measure that? Well, one way to do that is by taking a look at the shares outstanding. And so I did. This was just something I was looking at earlier today because I read that article and I thought, is this person interpreting the data correctly or what? Because indeed, we can see that if we go back to February, about a year ago, there was 470 million shares of silver SLV outstanding, and that is now up to 570. So that's 100 million more. But is that really a huge amount of money flowing in to ETFs to say that, you know, from its lowest point to the present, and that's the lowest point. So if I just go year on year, so here we are at the 25th or 6th today, 26th. So let's go to January 26th. Where were we? Is this the 26th? That's the 31st, 28th. Okay, so right in here, 500 million shares. So 570 over 500 is an increase of 14%. So the share count in SLV, that is the net creates, is 14 million shares. And a lot of that create took place up until here, which was back in late December. It actually, since that time, the share count has actually gone down, which means that there's been more net sellers in SLV. So when you see those types of things, I would say, okay, yeah, I think it's worth taking a look at, but then do a little bit more work to figure out whether that's really what you're seeing. So the ETF article, there's been inflows into SILJ, silver miners. By the way, we own some. Like, we own some SILJ, we own GDX. I think if people look at Alti, what do we have in this thing right now? I'll just double check. So in gold miners, we've got $70 million worth of that. Of GLD, we've got $60.5 million worth of that. In the silver miners, we've got $58 million worth of that. So when I say all of these things, it's not like, I'm speaking and saying, don't touch, don't ever touch. I mean, you guys have heard me say that I like these things generally. I'm just saying we're getting into pretty sketchy territory here with this big run. And it's very easy to say, oh, money is coming out of here and it's going into there. Well, money has been flying out of Bitcoin since the first week of October of last year. And this has been rising. So is it true money has been going into silver? Yes. Is it true that money is coming out of Bitcoin? Yes. Is it also true that money's been going into the Russell 2000? I mean, the Russell 2000 is outperforming the S&P and the Qs materially this year. So money is flowing out of the things that are underperforming and it's flowing into the ones that are outperforming. But I think if you make too much of some of these narratives, like, oh, the reason silver is rising is because of all of the big ETFs. And I look at this and I'm like, well, 14% increase. I mean, there's not a fund manager that wouldn't like to see that their shares outstanding increase by that amount year on year. It's pretty good. And their assets are going way up because the underlying asset itself is appreciating. But does that account for all of this? Well, it can't. It can't because silver is up since the 23rd of December by let's go to the 23rd here. You can see how much of a move we've gotten. And by the way, during this time, you saw what happened is that actually there was a slight decrease. I'll just go middle of the day. Okay. So it's only up 50%. Silver's up 50% over a period of time when the share count actually dropped by 15 million shares. So I agree that there is some money flowing out of these underperforming assets and into some of the outperforming ones, including silver. But I think that it's sort of that broader dynamic. And also then the thing takes off and everybody gets all excited about it. But yeah, I just still would urge some caution. I think we are in a very, very tricky neighborhood here. And actually, I don't like how this thing is behaving right now at all. like I said, my expectation had been that we were going to see, that we were bound to see one of these situations where it gaps up on the open and then trades to a new all-time high, which is where we got, and then closes sharply lower. Didn't happen, but I mean, look at this. I mean, if it had landed here, that would have been, well, that actually, wait a minute. I mean, look at this, because this is actually a 2-day chart. So let's take a peek. Oh, man. That was very close. Very close to a downside reversal. Gaps open, new all-time high, and almost traded lower on the day. We're here, we're above it. But that is awfully, awfully close. And look at this. This thing moved $14. I mean, it moved 12%. Okay. So, let's see. FinWest, I had puts on KView. Still below the 200, above the 50. Does feel like it's catching a little bit of a bid, though. And we are seeing a rotation. I personally like materials, industrials, things like that. If you're rotating out of technology more, is this one of these things where I love it as a long-term hold? Not necessarily, but these type of stapley type stocks. It does seem like it's sort of firming up here a little bit, just based on that. That chart I just had up, and it's generating decent cash flow. Not hugely expensive. I kind of call it a pair of twos in here. Steve Garcia, happy you're talking about silver. On the monthly chart, it has literally gone vertical. IV is extraordinarily high. If one puts on a short with options, how far out to go? 6-12 months. Yeah, so my thinking is that I would probably, I'm almost of the view that something is going to happen. I think something is going to happen soon. I mean, you don't need to look 6 months out. I think that something's going to break way before that. I actually was thinking, as a way to finance some of this, that I was actually thinking about buying some gamma. Or maybe trying to barbell it, and I'm still trying to structure this. I was basically saying to folks, look, because of what I wanted to do was just come up with a straight out bearish trade. That would have been nice, but that skew doesn't really work because the put spreads and so on. But yeah, I think we're going to get a downside move inside of 90 days. That's my own view, and I think it could actually come much sooner than that. And I mean, there was a reason I wrote the article yesterday, right? Because this is starting to have a really unhealthy feel to it. So let's see here. Some estimates have U.S. and China requiring 50% of silver produced for data center buildouts. Yeah, I mean, look, every one of these types of stories has to have a perfect storm to justify it. Because nothing goes up 500% as quickly as this has without a number of legs to the stool. So there has to be physical demand. There has to be a debasement trade. There has to be a flight to quality. There has to be a flight away from something that hasn't been working well, like Bitcoin. You have to have all of those things to prop it up. But the interesting thing is you only need one of them to get knocked out for the thing to turn ugly. In other words, you're not going to get a 500% rally just because somebody made a bullish call on it. You're not going to get a 500% rally because somebody says, oh, we have an industrial need for the metal. You need all of these things together because you can see over the course of 60 years, there have been parabolic moves of this type, but they are not super, super common. We're talking about a measured on both hands kind of a thing. This is the second largest since World War II, after the Hunt brothers. And Hunt brothers came undone because of things that are now currently in effect. Different margin rules, different market surveillance, different market structure. We do have something new now, which is more in support of the bull case, and that is that the market is much more accessible. In the late 1970s and early 1980s, most investors didn't really have self-directed accounts. There was no Robinhood and Interactive Brokers and Thinkorswim. Everybody couldn't just go out and say, oh, I want to be permissioned for futures. Yeah, me too. Who was trading it back then? Hillary Clinton, the Hunts. I mean, that's a little cheeky of me, of course. But actually, it was not that common a thing. Everybody didn't just pile into it. And she was focusing on cattle futures, by the way. Yeah, she was the Hunts, the family fortune, yeah, Nancy Pelosi, she was probably at it, but if she was, nobody ever inquired. What about putting on a short if you don't own silver? I suspect one wants a short delta, short Vega position. Yeah. So, the implied volatility here is very high as well. One of the reasons why I was thinking I wanted to get some gamma and sell longer dated silver vol to help finance it. But, yeah. What about gold? How high may it go? I don't know. I don't actually know how high gold would go. That market also feels hard to chase here, but silver is much more difficult. Because as I just pointed out, sometimes we don't really know the best way to think about gold in dollar terms if we don't really know what the dollar is worth anymore. It doesn't. There's a break that seems to be happening in sort of this multipolar world where people have decided, okay, we don't have this rules-based system, and therefore the currencies aren't tying out to one another all that effectively anymore. And that makes things a lot harder to place. So instead, the reason I was looking at silver versus gold is because whatever else is going on in the currency world, dollar versus commodity, I can compare these two commodities to one another, and what I can see is that silver, which was very cheap to gold for a while, has now become relatively expensive to it, which is the reason why I'm bringing this up now. Is gold also expensive? It would seem so to me, but I will admit that we're in a kind of an unprecedented space, at least in my professional life, and that's one of the things that's driving gold prices. I mean, it does. I would have a hard time chasing gold here, admittedly, but I'm more concerned about silver at the moment. So again, as Tucker D. Dog says, instead of Hunt brothers, it's data centers cornering the market is the thesis. And yeah, that's again one of the legs of the stool, but it does not take. Not every leg of the stool has to be knocked out for silver to tip over, right? You need all of those legs to build it up, but you don't need to lose all of them to bring it down. Hey, Mike, what are your thoughts on Intel and more room to the downside from We Seek Clarity 2961? Actually, I don't know, We Seek, whether you have been watching this for a long time. If you have been, you will probably know I've not really been a big fan of Intel. I have spoken repeatedly on the fact that Intel is one of these companies, Boeing was another, where it was run by engineers, then it was run by business people, and suddenly we got to a situation where you pick up a computer, it used to be a big thing, it says Intel inside, that was what you wanted, and now we get to a point and we say, and actually I'm looking at my laptop over here, that thing has an Intel Core i9 on it. This is one of the machines I use. I have some PCs over here as well. But now, speccing out new machines, and the preference is that we're looking for AMD. And we haven't quite corrected that. I have something else for you, which is that a lot of people bought into it on the back of the capital that was infused by the U.S. government, for example, and the investment that they made and others. And my question is, how many people are buying NVIDIA because they're getting infusions of capital? or AMD or Broadcom or Micron? And the answer is none, because those companies don't need capital infusions. They're trying to figure out what to do with all the free cash flow that they're generating. It's not a bull case. In fact, it's interesting because usually when a company does a secondary, the stock falls. And yet people bought it on the back of that. Now, if you bought it because you said, all right, well, that has pushed off the day of reckoning, their day with the executioner, because they were in trouble, I would agree. But ultimately, I'm not a huge fan of the company until such time as people say we prefer their products to their competitor, and that hasn't happened yet. Okay. In the 80s, we got quotes via the Wall Street Journal at your doorstep in the morning. Yes. Well, just think about it. I mean, isn't it amazing that Hillary Clinton, I'd like to make fun of this because I was a futures trader, and anybody who made the returns that she did immediately were like, yeah, that doesn't work. You don't put $1,000 into a cattle futures trading account, place thousands of trades, day trading cattle futures in the 70s when you couldn't get quotes. How do you day trade something when you have no quotes? Good question. Yes, you're right. Michael Anthony. Mike, what did you write? I wrote an article about SLV. It was published on CNBC .pro. Is that what it is? CNBC Pro? It's called CNBC Pro. I think it is CNBC .pro, or is it? It might be CNBC. I don't know where they publish it. I think it's CNBC.com. And then there's like a pro feature or something like that. What's that? Something about Mark Guthner I'm hearing. Oh yeah. You were asking what else I wrote. I wrote a book called The Options Edge, which was published in 2016 by Wiley. Mark and I put out that book together. I am not seeing the article in here. Although, yeah, William Maloney, thanks for the insight. You must have read my article. Yeah, because I published that. I wrote it yesterday, and it got published this morning. Let me see if I can find it. Actually, what am I talking about? If I Google my last name, Silver SLV, we'll probably find it. And so, there we are. Yeah, CNBC put it out 7 hours ago. And it was updated 5 hours ago. What did they update, I wonder? Yeah, so I put out these charts. So this is the gold-silver ratio that I put into that article. This is another way to look at it. So this is a histogram that shows essentially all of the levels of gold versus silver. And this is where we are right now. So has it ever been lower? Yes, but most of the time, higher. Okay? That's a good chart. That's the price of silver since 1950. You want to buy that? If you do, we got some other things for sale as well. Bridges, tulip bulbs, beanie babies. I think we got some of those. Can it go higher? Of course, but not going to see me advocating for that. This is just the collar, not the long stock position right here. So you can see that it gives you participation up to here, but it gives you protection over here. So you can see you get a lot more upside versus downside if you have SLV on, to put a collar on it like this. And this is an in-the-money call spread similar to the one I just showed you guys, but using our own openinterest.pro proprietary software developed by producer Jay, who can hear all of this as we talk. So yeah, that was available there. So thanks, Mike. Don't forget to hit that like and subscribe. Yes, please, folks, like, subscribe, recommend it to your friends. You like this kind of content. The more people who do that, the more likely it is we can continue to produce it. And Steve Garcia says, could you explain what you mean by buying gamma for silver? Oh, yes. Okay. So for those of you who don't know what that means, gamma is the second derivative of an option with respect to a price move in the underlying asset. Delta is the first derivative. What does that mean? If I buy an option that has a 50 delta, what that means is that for every dollar that the option appreciates, the option will go up by 50 cents. So in dollar terms, it appreciates at 50% of the rate. An option can have a delta, a call option can have a delta of anywhere from 0, it's so far out of the money that when the underlying moves, the options price does not move, to 100, meaning that for every dollar that the underlying moves, the options price also moves by $1. Puts can have a delta of 0 to negative 100. Okay, so for every dollar that the stock goes up, a negative 50 delta put will go down by 50 cents. So same thing. Now, the delta, which is the rate of change of an option, itself changes. And the nearer an option is to at the money and the closer it is to expiration, the faster that rate of change becomes. That's the second derivative. And that means that you have more convexity. What does that mean? So if I'm long an option, I get a shape like this. The more the thing goes up, the more delta it has. So I get a kind of a gearing, if you will. Well, options traders like to trade delta neutral if they're trading volatility. And so you want to own gamma. So if I buy a straddle, I have long gamma call, long gamma put. And if I buy a positive 50 delta call, I'll just come up with a simple example. So here is, let's see if I find a 50. So here's a 50 delta call-ish. Actually, the hundreds in SLV are very close to 100. So this is a 47 delta call, and this is a 50 delta put. In theory, these things should add up to 100 absolute value. So, but that's basically the at the money straddle. Now, what happens? And here's the, we can actually see the gamma, this is gamma theta ratio. But basically what's going to happen is as SLV goes up, the delta of my call option is going to go up, meaning that I'm getting longer, right? And the delta of my long put is going to go down, also meaning I'm getting longer, which means that as it goes up, I can sell stock. And as it goes down, I can buy stock. And that's what we call trading our gamma or delta hedging our gamma. And that's also what it means to be long volatility. So long gamma options positions are options that are net positions that are net long options. And short gamma positions are ones that are net short options. Now, you would listen to this and you would say, well, I always want to have a position where I get longer as it goes up and shorter as it goes down. And of course you would. If it was free, that's always the side of the trade you would take. But it's not free because options cost theta. That's the decay that you have, which is one of the reasons why a lot of options traders evaluate how much they want to be long or short by looking at the ratio of the gamma that they get to the theta that they pay. In other words, how much am I paying each and every day for the privilege of having a position that makes me long when it goes up and short when it goes down? In something like SLV right now, you can see why being long gamma has a lot of appeal. Now, this is one quick sort of an important point in all of this, is this is also why buying options when implied volatility is very cheap becomes appealing. So if we take a look at SLV and we take a look at the price of options over time as measured by implied volatility, so that's just going to be this chart, what you're going to notice is that options vol back in August was 23%. Now, it's 82. That's for an option that expires in 3 months. Now, this is a rolling look ahead, so maybe a better way for us to think about this would be to actually choose a specific strike or expiration and see how much the implied volatility has changed. So at some point, not that long ago, one could have bought January. I don't know how long these have been listed. Hopefully these have been listed for a while. Let's find out. So the SLV, no, those haven't been around that long. Let's see if I can find an expiration that's been around a little bit longer. Actually, you know what? It's not even that important for me to get to this. This is the important point I want to make. When implied volatility is very low, for longer dated options, if you think something could break or something could happen in this market, I'm not sure what or when, but between now and expiration, when vol's cheap, if you buy it and you just hedge the gamma all along the way, you might just be pushing. You might just, in other words, be breaking even. But then when something big like this takes place, suddenly you get all of this gamma. You weren't making a long delta bet in silver necessarily. You were just making a bet that volatility would increase. Now, as it happens, volatility in commodities, as we were previously discussing, often shoots up when the price shoots up. In the same way that for equities, very often, when the price falls out of bed, that's when volatility shoots up. That's why when the VIX goes up, when the S&P goes down, in commodities, it's kind of the opposite. When the price goes up, the vol goes up. So right now, to the point that Steve Garcia is making, it's not likely we're going to have 80% volatility in silver for another year, right? So vol is probably a sale, and I think silver is probably a sale. I would be much more definitive in saying that if we had gotten that official downside reversal. The upside gap, new all-time high, close at lows. You get that, that's not a good pattern. I've never seen that turn out well. I actually, if you guys can come up with an exception, I'd love to see it. But in my professional life, when I have seen that happen, it's almost always meant there would be, much lower prices coming in the near-term future. So anyway, I hope that helps. We have now taken up more than an hour of your time. As always, I appreciate your time and attention. And I hope you can join us. I'm going to double check and see if Mark Guthner is available for office hours tomorrow afternoon. I don't know if he is or isn't. But if not, be sure to tune in again on Wednesday at 4:15 Eastern Time for another open mic. Until then, thanks for watching.